And our continuing discussion on the economy, our next guest forecasts GDP growth for the second quarter to come in at 5.7% year on year. With us now for more is Senior Economist Vic Abola of the University of Asia and the Pacific. Good to have you back, Vic. Welcome to the program.
Good morning, Kami. Glad to be here.
Okay, so how did you come up with
Contribute whatever I
5.7%
can.
for the second quarter?
Well, that was a pickup in infrastructure spending, and I think there's also a late surge in consumer spending. I was in touch with Jollibee. They said their second quarter had been quite good. So I think it should be okay. I mean, except that we had a weak April, but May and June were very robust. So I still think it will reach 5.7, but we'll have great difficulty breaching 6%.
How sustainable, though? I mean, reaching 6%, Vic, on what constants or variables? Because presumably the August 7 tariff deadline will lapse and there would be an increase in tariffs.
Yeah, number one is the rate cuts. You know, the rate cut is so important for a number of reasons. Number one, I'm advocating for a 50 basis points rate cut. 25 is just a sort of a tiny, cut that there's not much what we raised during the time when there was inflation. There's no threat of inflation. I expect inflation to be at around 1% for July. Given relatively weak oil prices and as well as food prices, although you have vegetables always gets, but that's not important enough because rice prices are down. When we look at the Vietnam export prices of rice is lower than it was by the end of 2022, just when it started going up. And the forecast for oil all the way up to 2026 by the Department of Energy of the United States is downward. So, and a global economy that has weakened, including the United States, there's no reason why we should be fearing about inflation. As a matter of fact, if we look at the real yields of 10-year bonds, it's like in the top 1.8% percentile. So it's too high. So number one, your residential construction or the residential buyers are inhibited because it depends so much on your monthly amortization. Secondly, you have firms that are hesitant to borrow, to expand, and then overall construction activity gets bogged down.
Right. Vic, talk to us about the rate cut that you mentioned, 50 basis points. If we factor in the impact of the tariffs, and I know that you did some maths here, USEC Rose there made a mention of the impact of zero tariff concession and revenues, but what about the impact of 19% tariffs of Philippine exports to the U.S. and the impact it will have on GDP and the need for the BSP to possibly cut a lot more than 50 basis points?
Yeah, in the exports, as Rose has explained, I estimate only around 6 billion of our exports will be affected because there are a lot of exemptions. So it's not very, very large in terms of our impact on us, and we'll be at the same boat as the other ASEAN countries. However, the other side of that's not very much considered is the impact on the local exporters' profit, bottom line, right? Because if you right now have to pay 17%, or you will get 17% less from what you export, you either raise your prices or bite the bullet, partly at least. That might slow down the exports a little bit from where we are. We had a very strong June, But I think that we can still manage with a 10% growth for this year, despite the situation. And I think that, in terms of competitiveness, uh, the main problem is not the tariffs. I mean, what we need to do are, mentioned, cut policy rates sharply. That does not only help private sector, it will also help government in the terms of their fiscal space. 1% drop, 100 basis, okay, a half percent, let's say a half percent cut can my estimates around close to between 5 to 10 billion pesos in interest savings
Could
of
I
the
pick up
government.
on
That will
peso, Vic?
offset.
Because very important that you make a mention of the role that the local currency has in managing the impact of slower growth and faster inflation. Right now, we are at a 29-month low in the peso
Yeah,
against the dollar. Where would the
yeah.
peso have to go to cushion
Well,
the
it will
impact
have to go.
that we have to protect exporters from the tariffs?
Yeah, you will have to go, at least you'll have to go, down by 5% because assuming that the buyers in the US agree to a split of the profit of the price. So you should be depreciating it, allowing the currency to depreciate by at least 5%. That's not too much because that's only about 2% in terms of, you know, and if you look even the BSP studies, former government Tatango used to say that a 1%, or let's put it 2%, only results in 0.2, there are about 0.2% increase in inflation. Now, my own annual forecast for the inflation is 1.6%. So we're way below the targets. So BSP can afford. The problem is not inflation. It has shifted to growth because we've seen it in the first quarter, and we're not achieving the 6% because the focus is wrong. I mean, the focus is the growth because our problem now is that we'll have a lot more of imports from China. China will divert its exports away from the US. Also, we should expect more imports from India. Uh, all of these countries that have a big economies be exporting to us. So we really don't have no choice. We have to depreciate the currency in order to
Okay,
protect
well,
local
we'll have to leave it
producers.
there, Vic. So much to talk about, but we'll know the lowdown in the next 24 hours with inflation out and GDP in the next 72. Thank you so much,
All
Vic
right.
Abola of the University of Asia
Thank you
and the
very much.
Pacific.
Sure.